Tonight, a seismic shock has hit one of America's most iconic companies. In a dramatic escalation of the trade war, China has ordered its airlines to stop accepting deliveries of all new Boeing aircraft. This move is a direct response to new American tariffs and effectively freezes Boeing out of one of its most critical markets. The consequences are immediate. Boeing's future growth is now in jeopardy, and the global aerospace industry is on edge. This is the most severe blow yet in a trade conflict that's been intensifying for years. The re-elected Trump administration's tariffs on Chinese goods triggered swift retaliation. China slapped massive tariffs on U.S. imports and banned Boeing planes and parts. For Boeing workers in Washington and South Carolina, the news is devastating. Their jobs are now hostage to a geopolitical standoff. Finished airplanes will pile up, creating a financial nightmare for Boeing and threatening thousands of American jobs. The ban on U.S. aircraft parts also disrupts China's existing fleet of Boeing jets, risking grounded planes and highlighting the deep economic ties between the two nations. This blockade weaponizes interdependence, raising the stakes for both sides. The world is watching. Can Boeing survive being locked out of a market it spent decades building? The answer will shape not just Boeing's future, but the future of global trade. The next moves could redefine the balance of power in aviation for years to come. To grasp the crisis, you need to understand China's role in global aviation. China was set to become Boeing's largest customer, accounting for 20% of global aircraft demand. For decades, Boeing's partnership with China was a symbol of U.S.-China economic cooperation. Chinese airlines operate huge fleets of Boeing jets, and Boeing even opened a 737 delivery center in China. Losing this market is like losing your biggest dealership overnight, an almost impossible gap to fill. The timing couldn't be worse. Boeing is still recovering from the 737 MAX crisis and years of slowed orders. Now, over 140 jets built for China are stranded, customized for airlines that may never take delivery. Finding new buyers means costly discounts and logistical headaches. This isn't a temporary setback, it's a fundamental disruption to Boeing's business model. The loss of China leaves Boeing scrambling to reinvent its future. The halt in deliveries has triggered a cash flow crisis for Boeing. Airlines pay most of a plane's price on delivery. Now, billions in revenue are frozen. Boeing must still pay workers, suppliers, and service its $60 billion debt, but its income has vanished. The company was counting on 2025 deliveries to recover, but now faces mounting storage costs for undelivered jets. Boeing's growing fleet of whitetails, jets without buyers, must be sold at steep discounts, further eroding profits. The uncertainty is palpable for workers and suppliers. Production slowdowns threaten jobs across the country. Every undelivered plane is a financial and logistical headache. The ripple effect extends to thousands of small businesses in Boeing's supply chain. Communities built around aerospace are bracing for layoffs and economic pain. Boeing's financial health and the livelihoods of many Americans are now at risk. The company faces its toughest test yet. As Boeing is shut out, Airbus steps in to fill the void in China. The European giant is now the go-to supplier for Chinese airlines with hundreds of planes on order. Airbus's local assembly line in Tianjin cements its role as a trusted partner. This shift could permanently tilt the balance of power in global aviation. Meanwhile, China's own COMAC is poised to benefit. The C919, designed to rival the 737 MAX, is now the focus of government support. The trade war is a marketing windfall for COMAC, as state-owned airlines are pushed to buy Chinese. COMAC is also eyeing expansion into Southeast Asia and beyond, with recent approvals in Vietnam. While COMAC can't yet match Boeing or Airbus in scale, it now has a protected home market and political momentum. The crisis accelerates China's ambitions to break the Boeing-Airbus duopoly. For Boeing, the competition just got fiercer. The global aviation landscape is being redrawn. The impact of China's ban ripples through America's vast aerospace supply chain. Boeing's slowdown means fewer orders for giants like GE Aerospace and thousands of small suppliers nationwide. Many of these businesses rely on Boeing for survival. Canceled orders threaten jobs and entire communities. Smaller suppliers lacking financial reserves face layoffs or closure. The ban on U.S. aircraft parts also disrupts maintenance for China's Boeing fleet, but it's a double-edged sword. American exporters lose a major market. The crisis exposes the vulnerability of globalized supply chains. Companies must now rethink where and how they manufacture, weighing the risks of international dependence. The result? A more fragmented, less efficient industry, and higher costs for everyone. America's advanced manufacturing base is at risk of permanent damage. The aerospace sector's pain could echo across the entire economy. The stakes have never been higher. The Boeing ban is just one front in a much larger US-China economic war. Tariffs have thrown global trade into chaos, with the WTO warning of an 81% drop in US-China trade if current policies persist. This means higher prices, lost exports, and economic pain for American families and businesses. The US stock market lost $1.5 trillion in a single day after the latest tariffs. Major companies like RTX and GE face hundreds of millions in losses. The dollar's decline makes imports pricier, squeezing consumers. Tourism is also hit hard. Chinese visitors are down, threatening $90 billion in revenue and jobs across the US. Cultural ties are fraying, replaced by suspicion and barriers. China is fighting back by restricting rare earth exports and shifting energy deals to Russia and the Middle East. Each move opens a new front in the economic war, deepening global instability. The world is being forced to pick sides. There are no winners, only mounting costs. The fallout is global, and the end is nowhere in sight. The crisis is accelerating a global decoupling. America and China are pulling their economies apart. Both sides are racing to localize supply chains and reduce dependence on each other. The US is pushing to bring manufacturing home, while China's dual circulation strategy boosts domestic self-sufficiency. Promoting the COMAC C919 is part of China's plan to replace Boeing and keep billions in its own economy. The world is splitting into rival economic blocs, forcing other nations to choose sides. The era of seamless globalization is ending, replaced by fragmentation and competition. Hopes for de-escalation are slim. Both governments are digging in. Businesses and workers are caught in the crossfire, facing rising prices and job insecurity. Even US states are fighting back. California is suing the federal government over the tariffs. For ordinary Americans, the future means more volatility, higher costs, and fewer opportunities. The dream of affordable global travel and stable jobs is fading. Only bold leadership and compromise can reverse course. Until then, the world holds its breath as two giants reshape the global economy.